In 2019, China became the second largest bond market in the world. And after Bloomberg and JP Morgan, FTSE Russell recently announced that it will include China's government debt in its indexes starting October 2021. Given the options to buy into the investments that track these indexes, it is important to understand China's government bonds. As the world is still suffering from the pandemic, are those bonds great investments? How has the Chinese Communist Party been trying to make them appeal to foreign investors? And what are the unknown risks? The investor's new safe harbor. The main selling point of Chinese government bonds is the higher yields. As of September 24th, the 10-year Chinese government bond yield was 3.08%. In comparison, the 10-year U.S. Treasury yield was only 0.67%. On top of that, Beijing has been trying to make its bond market more accessible. As early as 2017, the CCP created the Bond Connect to attract foreign investments in Chinese bonds. With that, qualified foreign investors can invest in China's bond market without setting up shops in the country. And there are no quota limits. One obvious risk for foreigners investing in China would be the currency exchange rate movements. Some investors might fear the yuan will depreciate against the US dollar and erode the returns. And risk hedging comes typically with costs, especially when the yuan's futures price is lower than the current spot price. Likely to address the concerns, the People's Bank of China, China's central bank, has been heavily intervening in the foreign exchange derivatives market to boost the yuan futures prices since 2016. The operations have been making it cheaper for foreign investors to hedge the currency risks. In September 2019, the CCP removed the quota limits under the Qualified Foreign Institutional Investor and the RMB Qualified Foreign Institutional Investor programs to further open up its financial markets. As a result, the major global index publishers agreed to add Chinese stocks and bonds to their indexes. The higher yield, broader access, and lower hedging costs certainly have made China's government bonds look very attractive. Since 2017, foreign investment in China's bond market has been growing by 40% annually, and at the end of August, foreigners held about $410 billion worth of Chinese bonds, or 2.5% of the country's entire bond market. But as the old saying goes, if it seems too good to be true, it probably isn't true. So what is the catch? The large uncertainties in the Chinese economy. One primary consideration in buying any bonds would be the credit risk. As the name suggests, China's government bonds are backed by the central government, but ultimately, they will have to be backed by the country's economy. Since the start of the US-China trade war, the conflicts between the two countries have escalated. The United States has been investigating the CCP's spy activities, tracing the origins of the current pandemic, and confronted the regime on the Hong Kong security legislation. It now sees the CCP as a threat and has imposed certain sanctions. From a trade perspective, the US has revoked Hong Kong's special status. The CCP can no longer obtain sensitive technologies through the once autonomous city. Starting September 15th, the US would cut off the supply of chips to Huawei. Over 200 Chinese companies traded in the US face delisting due to the failure to meet US accounting standards. Decoupling has become a trend. In the words of Xi Jinping, the CCP's general secretary, China needs to, quote, gradually set up a new development framework that is mainly based on internal circulation and let domestic and international trade collaborate with each other. The worsening external environment and the slowing Chinese economy bring significant uncertainty, and the resulting increase of government debt could lead to heightened default risk. But maybe investors should be even more worried about the hidden risks. The local officials' strange motivations. Having a totalitarian government means that all of China's local government officials are appointed by and follow the central government's orders. And with unlimited power comes unlimited liability. This explains why Beijing issued 1 trillion yuan of national debt this July and transferred the funds directly to municipal and county-level governments. In 2019, the central government's general revenue was 9.25 trillion yuan. Its expenses were only 3.5 trillion yuan. But it had to make transfer payments totaling 7.44 trillion to the local governments, resulting in a 1.83 trillion deficit. This was because the local-level governments had revenues of 10.1 trillion, but expenses of 20.4 trillion. Despite the transfer payment, the local-level government still ran an overall 930 billion deficit. Although the central government seems to be taking in more revenue than it needs, the surplus eventually goes to the local governments. The CCP's evaluation system has also been contributing to the debt problems. The promotions of local officials are closely tied to their jurisdiction's GDP growth. They have enough motivation to increase investments by issuing large amounts of debt. The return on investment and financial sustainability are not priorities. As a Chinese author, Liu Haiying wrote in the book named China's Massive Debt: The Economic Miracles, Root and Future, the local governments are not overly concerned about it. They understand clearly that the debt will be repaid by someone else, regardless of whether it is the bank or the central government. Every rational person would pursue such a desirable job where one can buy achievements with other people's money. Such a mechanism has caused even higher debt burdens for the CCP. The vulnerable hidden debt. By November 2019, China had 37.6 trillion in official government debt, with central and local government debt amounting to 16.28 trillion and 21.33 trillion respectively. Besides, the IMF estimated that in 2018, the local governments had 30.9 trillion in hidden obligations, and by 2024, the central and local governments will owe 124 trillion in total. A large portion of the debt will mature between 2020 and 2024, averaging 4.8 trillion per year. Most of the new debt has been used to roll over the previous borrowings. The hidden debts are usually attributed to the local government's financing vehicles, or the LGFVs. In short, the LGFVs appear to be corporations with high-quality assets, but in fact, they are created by local governments to borrow money off the books. According to a 2019 report by the CICC, China's top investment bank, from 2014 to 2018, the LGFVs are those with the fastest growing debt loads, the lowest return on investments, and the worst loan repayment abilities. For example, in December 2019, the Hohhot Economic and Technological Development Zone Investment Development Group, an LGFV owned by the Hohhot local government, failed to repay 1 billion yuan of debt and ended up negotiating for an extension. The burning question is whether debt-strapped governments will be able to quickly bail out LGFVs that become distressed, S&P Global Ratings said in a report. The stakes are high. If defaults or bankruptcies among high-profile LGFVs become epidemic, it would erode market confidence, tarnish government reputations, and destabilize the financial system. Incomplete statistics showed the number of LGFV defaults amounted to 23 in 2018 and another 23 in 2019. And since the mid-1990s, the LGFVs have become the drivers of China's economic growth. But they are closely linked to the country's shadow banking industry, making it difficult to assess their risks. 831 local governments have defaulted. If you are a government contractor, don't expect to get paid once the work is done. What you should expect are IOUs and unknown payment dates, says Wang Dianshu, a lawyer in Beijing. China's economic growth has been slowing down. The deteriorating local government finances have caused the missed payments to contractors and led to lawsuits. In the first 10 months of 2019, 831 local governments were behind on debt repayments. The total missed payments were 6.9 billion yuan, not including what was owed by the LGFVs. As an example, in October 2019, the local court ruled that the Nanchang city government defaulted on 161 million yuan. It is not easy to hold the governments accountable for their obligations, and there is no official way to repay government debt by liquidating public assets. As Mr. Wang said it, "I don't think there has been one bureaucrat punished for not paying the contractor. They are above the law." The foreign reserve crisis. China has the world's largest foreign currency reserve of more than $3.1 trillion. But a Bloomberg article stated that, based on the IMF's criteria, this number is just above the minimum requirement of $3 trillion. Despite the strict capital controls, China's 2019 unaccounted capital outflows was close to $200 billion. And some economists believe that funds are leaving China in more creative ways. Adding to the problem has been manufacturing businesses relocating to other countries. Therefore, it is understandable that the CCP has become more open to foreign investments. The regime has found itself in a crisis. In the long run, it needs foreign capital to stabilize the yuan, drive economic growth, and maintain its power. Stabilizing foreign investment will help stabilize the economy, and that will have a direct impact on the exchange rate. A senior Chinese policy advisor told Reuters, "The regime is not trying to create a safe harbor for investors. On the contrary, the foreign investors are helping the CCP to stabilize the yuan and the economy." In a Forbes article titled, "Michael Lewis Should Write Liar's Poker 2 Set in China," the author William Pesek stated, "There is, after all, a huge paradox at play, as China welcomes the participation of overseas punters who prize transparency and regulatory and legal certainty. On President Xi Jinping's watch since 2012, China has become more of a black box." Greed and fear. Investments with higher potential returns often come with higher risks. The media and rating agencies used to play a critical role in helping investors assess investment products. And in earlier years, it was easy to find insightful analysis regarding the CCP. Unfortunately, they are now scarce. While the CCP has not become more transparent and trustworthy, a few months ago, the party decided not to recognize the Sino-British Joint Declaration and broke its promise to keep the one country, two systems framework for 50 years. Maybe China's government bonds are not investors' safe harbors. Instead, they might be well-designed traps. As Warren Buffett once said, "Be fearful when others are greedy, and to be greedy only when others are fearful." What's your opinion about China's government bonds? Leave your comments below. Thank you for watching Unseen Fortunes. If you enjoyed our content, please click like, subscribe, and share. We'll see you next time.